Well, welcome to our coverage of the last part of Chapter 25 and first few parts of Chapter 26. So Chapter 26 I split in half. It just works out better that way. And the other half we'll cover the next class meeting. So as we look here at Chapter 25, and we take a look at what we had not covered yet, we still need to cover the section on pricing, so how a company sets its price. So thinking about pricing, just some issues here, and by the way, it's almost all non-computational, so I think you'll find it pretty easy. So in pricing, little introduction. Well, a company wants to be profitable in the long run, must have a price for its product which will allow total revenue over the life of the product to be greater than its total outlay and total opportunity cost for the product. So outlay, again, cash is expending out of pocket or through accounts payable. Opportunity costs, something that's given up. Of course, the price consent is affected by the dynamics of the economic marketplace as influenced by customers and competitors. So in this chapter, we're going to consider all costs and value chain for a particular product. And all these costs must be covered by revenue in the long run in order for the company to be profitable. So we can note, again, the value chain is divided into pre-production or upstream costs, production or manufacturing costs, and post-production or downstream costs. We covered that earlier in the course. So if we want to be profitable, our price has to be greater than the product's full cost per unit. So all those value chain costs, both variable and fixed. So again, in the long run, all those value chain costs must be recovered through revenue. Therefore, the average long run price for a product must be greater, as I said, than this product's full cost in order for the company to be profitable. And generally, the average long run price covers the product's full cost plus a normal profit margin, which covers the opportunity cost of the capital investment. In other words, capital or money is tied up in this. It could be used elsewhere to earn a return. So we want the return on this product, whatever it may be, to at least cover the opportunity cost of where they can invest that capital otherwise. Now, there are two different approaches to setting a long run price: cost-based, or sometimes called cost-plus pricing, and market-based pricing. So thinking about cost-based pricing first, this is probably what most people think about when they go into business. Well, cost-based pricing involves adding a markup to the cost base for the product. And the cost base is usually the product's full cost. Again, that's the sum of all upstream, manufacturing, and downstream costs per unit, both fixed and variable. And the markup is subjectively set and involves such decisions as the company's target return on investment, again, covering the opportunity cost of the capital invested. And cost-based pricing is internally driven. We just think about it without really considering the outside forces of the market. We'll talk about those under the next approach to pricing. But cost-based pricing tends to lead to a price which is simple to compute. Recovers all costs. It's easy to justify and it's stable. However, it's not responsive to market forces. So let's say that we were to determine that that company's full cost base is $20. So the full cost per unit is 20 bucks. And let's say that we decide to add a 50% markup to it. That would be an extra $10, giving us a price of $30. Let's see, there we go. Hold my little Dollar Tree whiteboard up there. Alrighty. So that markup is how far above the cost we put the price. So in this case, we add 50% to it, which is another 10 bucks. So nice, easy to compute. But the problem is we might try to charge 30 bucks and some competitor down the road undercuts that price. So in a competitive environment, this is not the best approach. You know, with these little whiteboards, when I go back to my hometown for Thanksgiving, just last night, the county was declared a red zone, which means schools are out, at least live, until December 7th. So, yeah, I'm curious at Dollar Tree, I wonder if some teachers will buy these up. They may need them for home instruction. Yeah, and it said the students log in at the regular class time, so they'll be going all day. I feel sorry for the teachers having to make sure they occupy their time for all that time. I mean, that'd really be hard with K through 12 students trying to keep them from being distracted at home. And the poor parents, if they have to work, oh, lots of things to consider. So a couple of things here about cost-based pricing back on the handout. Well, first of all, cost-based pricing is often more appropriate for monopolies, oligopolies, or regulated industries. The reason is they all have some control over the price. And also companies which make specialized made-to-order products often use cost-based pricing because there's no established market price for their products. So sometimes people feel ripped off by that, quite frankly. Feel like they're paying too much. Well, market compensation is often contingent upon achieving a target return on investment. Thus, managers want to set prices which will enable them to meet their target return on investment as they will receive their bonuses. And that's why so many companies base their cost plus price calculations on target return on investment. Now, if we don't do that, the other approach is market-based pricing. So market-based, or sometimes called target pricing, is based upon the market forces of competitors and customers. It implies that the price charged can be no higher than what customers are willing to pay. So here's where, if we have competition, we can think about pricing. Because if there is competition, that market-based price is set for us. We've got to take what the market will bear. An excellent example of this would be the stock market with stock pricing, because that price would be would already be computed for us. Another would be for some type of commodity, such as gold, silver, platinum, or a farm commodity like bushels of wheat, bushels of corn, bushels of soybeans, because again, for those, the market price is set. So in the case of farm commodities, most notably by the Chicago Board of Trade. Growing up in the Midwest, I well remember all the farm prices being announced on TV and on radio because of very big interest to farmers. So if you're a farmer, you have no control over the price. You've got to make sure that your costs are low enough so that you earn a profit. And if you don't, like ever so many family farms, you'll go out of business. So thinking about this, well, first of all, the price which customers are willing to pay is the target price. So the market price, the target profit margin, what you want to earn, whatever that may be, is then subtracted to yield the target cost of the product. And the target cost may be lower than the company's current full product cost, so the full product cost will have to be reduced by improving the company's products and processes through value engineering. We mentioned that term before. It's where we go back through all the activities going into the product and therefore the costs. We've got to get them low enough so that we make that desired profit. And market-based pricing is appropriate for competitive industries. For example, producers of fungible goods, which by the way means one unit substitutes perfectly for another unit. Good example, agricultural commodities must take the market prices given. So 1 bushel of wheat substitutes perfectly for another bushel of wheat. 1 bushel of soybeans substitutes perfectly for another bushel of soybeans. 1 ounce of gold substitutes perfectly for another ounce. So, gotta take that market price as given. Well, thus they are price takers. Someone who can control the price, such as a monopoly, is a price setter. So this time we have a price taker. They use cost data in deciding which commodities to produce and for cost control. So the full product cost is not greater than market price. Here, number 3, cost incurrence is when resources are consumed. And traditionally, managerial accounting focuses on cost incurrence. And traditional methods of cost control, such as variance analysis, which we didn't study much in this course, we just mentioned it, focus on controlling costs as of or after they're consumed, because variance analysis compares the actual cost to the budgeted cost and looks at the difference. Well, locked-in or designed-in costs have not yet been incurred, but they will be incurred due to past decisions. And often the majority of costs are locked in by the design stage. Value engineering attempts to control costs before they're locked in, within the constraints of satisfying customer needs. So trying to eliminate everything that does not add value to the product, eliminate those activities, and therefore eliminate their costs. So a non-value add activity with a non-value add cost attached to it, let's get rid of if we can. Let's try to keep those activities which do add value and therefore will be stuck with those costs too, value add costs. Well, value engineering attempts to control costs before they're locked in, within the constraints of satisfying customer needs. And traditional cost accounting has not really recognized the opportunity of this sort of ex-ante cost control, meaning before the fact of controlling costs, and instead is focused on ex post or after the fact comparisons of costs actually incurred with budgeted costs. Both kinds of cost control are important. However, in many cases, there's a greater potential for cost reduction in the design stage because a larger proportion of the costs are locked in at the design stage. A design has historically received less cost-cutting attention than is manufacturing. So if we can build it cheaper from the ground up, while it's still good enough for consumers, that's what we're trying to do. Just like the car radiator grill that we mentioned some time ago, these days one piece of injectable to plastic with Mylar on it to make it look like chrome, whereas a 1959 Cadillac, as we mentioned then, that radiator grill is made of real chrome, plus it has over 500 individual parts. So Cadillac finally decided that that complicated real chrome radiator grill is a non-value add cost. They eliminated it. So number 4, value engineering can focus on each type of cost. And we can note that reducing the quantity of the cost driver is a valid way of reducing costs oftentimes. Again, just like the number of parts in the Cadillac radiator grill. Then to achieve target costs, many companies use Kaizen, which is the process of continuous improvement. Much of the cost reduction occurs gradually via many small improvements. Just keep fine-tuning, tweaking, etc. By the way, also, since direct materials is often a significant cost, many manufacturers work closely with their suppliers to achieve target direct materials costs. So Toyota, for example, has sent its own engineers to help suppliers produce more efficiently. And of course, much of that cost saving is passed directly back to Toyota. So if Toyota can help its suppliers produce more efficiently, well, that means a cheaper product coming out of the supplier, just like cheaper truck seats coming out of a supplier for Toyota near my hometown. And Toyota did send its own engineers in fact, to help this former mom and pop company produce more efficiently, and also to expand production out of what was originally their garage at their hometown in Illinois. So Toyota did that, helped mom and pop build cheaper truck seats, And then finally, mom and pop had their own plant near the new Toyota plant. So it worked out well for mom and pop, and then they finally sold it. Well, number 4, value engineering can focus on each type of cost. But we can note that number 6. Thought something sounded really familiar there. So value engineering to achieve target costs requires cooperation across different business functions. So for marketing, to decide how much customers are willing to pay, and also what product features can be deleted without you losing market share. And those would be known as non-value added costs. And also which features should be added to increase perceived value, also known as value added costs. Across engineering and manufacturing, the design for manufacturability so that we can make it on the assembly line, and across cost accounting, the estimated changes in cost from proposed changes. I bring these up because traditionally not all of these areas have worked together very well, but if they want to have a better product and have one that incorporates value engineering into it, they're going to have to. Sometimes in the introductory management class, we will hear about silos within an organization, which means that people tend to stick to their own. So they stick to each of these types of functional areas, people that work just like them, and they don't venture out of those silos too often. And that concludes chapter 25. The questions are on 25. All righty. Here we go. All right, let me look for one other thing here under chapter 26 before we start. That's not it. Bear with me a second. That's okay. Let me let Jennifer in here. Oh. Forget that one. Oh, well. That's okay. Hi, Jennifer. So what we'll do here next in chapter 26, which by the way is the last chapter for the course, we'll be taking a look at capital budgeting. So how we budget expenditures on things like long-term assets or some other long-term project. And we will see that that's called capital budgeting. So we'll be deciding upon which project or other long-term expenditure to invest in. So tonight I'm going to cover section 1, section 2, and also section 3 here. The last sections I'm going to save until we come back again on Monday of next week. So capital budgeting, or shifting from the short term into the long term, more than 1 year, and in most of these, much more than 1 year, but most of these examples that we will see. So we'll see 4 different methods for deciding whether to invest in some long-term project or not. And 2 of these are going to require the time value of money. So those are the ones I'm going to save until we come back on Monday. Also with these, you're going to see them coming up again in your managerial finance class. So this will give you very good preparation for that. Well, let's look at a few of the underpinnings first in the introduction. So first, capital budgeting is a process of making capital investment decisions regarding the acquisition or purchase of new capital assets or other investments. Examples include this. Could be a new building, could be a new factory, could be some new equipment, or it could even be a major website or some other intangible. That's fine, same thing going on. For example, when Publix several years ago decided to have SAP as their ERP, meaning Enterprise Resource Planning System, SAP being a German company, well, they had SAP people out there for over a year. That was definitely a capital investment. So a capital investment usually involves a large amount of cash to be expended. Very true. And again, more than 1 year. Well, management must engage in what is called capital rationing to decide the projects in which it will invest its limited funds. So for which of these possible capital investments will we get the biggest benefit, the biggest return? And that's what we're going to try to decide as we go through the capital budgeting methods in this chapter. Now in B, again, the time frame is long run, more than a year. Therefore, management has control over such expenditures. It is not the short run, because the shorter the time frame, the less control that we have over things. The longer the time frame, the more that we can change up. So that's what that's saying there. Well, then C, the future cash flows, the investment will be used in 3 of the 4 methods that we're going to study. Therefore, non-cash items, such as depreciation, will not be included. And this ties in the statement of cash flows and financial accounting because, again, even though depreciation is an expense under the accrual method, so under the accrual method of financial accounting, which is what we study in 2111, it's GAAP, well, it's not a cash outflow. So it's a non-cash expense, we often say. And just a few little notes here. The future cash inflows will include cash revenue from the investment, cash operating expense savings, and the cash residual value of the investment. Now I will show you. And future cash outflows will include cash operating expenses from the investment, and the initial cost of the investment is also a future cash outflow, but we'll consider it separately. And we'll net the two to derive future net cash inflow. And indeed, even though our budgeting may appear to be precise because we're given exact monetary amounts in our problems, we can remember the actual amounts can differ from our budget amounts. This becomes even more uncertain as the time frame of the decision increases. Therefore, more risk is involved as the time frame extends. So the farther out in the future, the less certain we're going to be because we just don't have a crystal ball, to put it mildly. And a compensating control for this is to do what are called post audits to make sure that actual cash flows are going according to plans. And if not, corrective action can be taken, even up to abandoning the project if we have to. So post audit kind of tweaks things as we go out there in the future. So after a year, maybe do a post audit, just see how things are still stacking up. After another year, do another one, etc. So 2 of our capital budgeting methods will ignore the time value of money. Those are the 2 that we will see here in this video. And the other 2 will include it. They're therefore more sophisticated. But two that we will see tonight, even though they're fairly quick and easy, they can be used as an initial screen for projects and then subject them to a more sophisticated capital budgeting method that we'll see in next week on Monday. And that will help us decide finally what we should be investing in. So let's start with our very first method called the payback period method. This one's really quick and easy. So what we have in A, this method reflects the length of time it takes to recover the initial cost of the capital outlay or the capital expenditure by dividing it by expected net cash inflow. And usually the shorter the payback period, the more attractive the asset will be, ceteris paribus. As we know, ceteris paribus is a Latin term which means all other things being equal or unchanged. We use that a lot in economics. So two scenarios. First of all, when annual net cash inflows are expected to be equal, and then unequal. So if equal, well, the payback period, how quickly we get our money back, in other words, is going to equal the initial investment divided by expected annual net cash inflow. So for example, what is the payback period for a machine with an initial cost of $100,000 and an annual net cash inflow of $20,000? Here's the answer. It's quick and easy. We simply take that $100,000 initial outlay or expenditure. We divide that by 20,000 to give us an even 5 years. So we're just saying that we get our money back as quickly as within 5 years. Obviously, shorter is better here. We want to get our money back as quickly as we can. Well, then C. Second scenario, again, is when annual net cash inflows are expected to be unequal. So the payback period equals total net cash inflows until the initial investment is recovered. So I will show you. So an example, what is the payback period for an asset with an initial cost of $100,000 and the following net cash inflows for the first 4 years of its life? They're unequal. So $20,000 in the first year, second year $35,000, third year $25,000, and fourth year $40,000. So as I look at the answer here, I can start at year 0, so the very initial part of year 1, if you will. So when we make that initial expenditure through year 4. So I look at how much was not yet paid back at the beginning of the year, not applicable for year 0. Cash inflow during the year, again, not applicable to year 0. And then how much has not yet been paid back at the end of the year? Well, here at year 0, as we start on this, $100,000. I carry that over to year 1, beginning of the year, not yet paid back. Excuse me. I subtract off cash inflow during the year of $20,000. That gives me at the end of year 1, not yet paid back, $80,000. I take that down here to year 2 because end of year 1, same thing as beginning of year 2. So $80,000 remaining balance, if you will, at year 2 beginning. Then in year 2, $35,000 is paid back. Subtract that. Not yet paid back at the end of year 2 is $45,000. I carry that down to year 3 beginning. Again, end of year 2, same thing as beginning of year 3. $45,000. In year 3, the cash inflow is $25,000. That brings us down to an unpaid amount of $20,000. End of year 3, same thing as beginning of year 4. Then the cash inflow during the year in year 4 is $40,000. Not yet paid back, we're over. So we can compute a partial year. So in year 4 is $20,000 remaining divided by the net cash inflow of $40,000. That's half a year. So this spills over into half of year 4. So the payback period is 3.5 years. So 3 full years we saw, plus half a year into year 4. So that's how we would do it if unequal. And any questions here so far? Okay. Well, some advantages of the payback method are that it's simple to compute. It focuses on the time it takes to recover the company's initial investment. And disadvantages are that it focuses only on how much time it takes to recover the cash, and therefore ignores accrual accounting profitability. It also ignores any cash flows that occur after the payback period, including any residual value at that time, or salvage value, same thing. It also ignores the time value of money. And in E, since the payback period method is quite simple, again, managers usually use it as an initial screening method. And if an investment appears to be desirable, then it's usually subjected to a more sophisticated screening method to decide whether to invest in it. And that takes care of payback. Any questions on it? Alrighty. So the second method, which is the last one that we will talk about here in this video, is the accounting rate of return method. Now, different editions of this book call it a different acronym. It can be called the ARR method or the ROR method, which is what the current edition calls it. So rate of return method, I think ARR is the better one because it includes accounting. So I wanted to bring both those up because you might see the other one in your managerial finance textbook. So what this is, it's a little bit more sophisticated than the payback period method. This method's going to, excuse me, measure the mean rate of return on the investment using accrual accounting operating income. Let me get a drink of water here. Well, in B, this accounting rate of return. So it will be a percentage, and obviously a rate of return we always want to be greater. So higher is better here, whereas in the payback period method, we want to get our money faster, so lower is better there. So ARR equals mean annual operating income for the investment divided by the mean amount invested in this project, this capital project, whatever it may be. So then in D, or C rather, the total operating income from the asset was that, well, it equals total net cash inflows during the operating life of the asset minus depreciation and any other non-cash expenses related to the asset during its operating life, like amortization expense. We're subtracting that off because we are trying to get to accrual accounting income. The difference between that and cash income, being total net cash inflows, will be depreciation or other non-cash expenses. Then in D, the mean annual operating income equals the total operating income for the asset divided by the asset's operating life in years. I will show you an example of this in just a moment. And then in E, the mean amount invested in the asset is derived by adding its net book values at the beginning and end of its operating life and then dividing by 2. So thus, the initial cost plus any residual value or salvage value, same thing. Whoops, cat's trying to get my attention here. And we'll divide that by 2. I've had some students that have had cats coming up to them during class, or they've had their cat sitting on their lap or their dog sitting on their lap. So get a little glimpse of each other's pets. I will go over F, G, and H in just a little bit, but I'd like to go over I first. So some examples, short exercise 26.4 through 26.6 on page 1465. But I've actually got them for you here. So I do have these in a PDF, which you do have on Canvas. Let me just rotate my PDF. Oh, please rotate. Why will I not rotate? Oh, whoops, pressing the wrong button, pardon me. There we go. So first of all, in short exercise 26.4, using the payback and accounting rate of return methods to make capital investment decisions. So if we look here, we will see a long-term investment here, so a capital investment, capital expenditure. We can consider how Hunter Valley Snow Park Lodge could use capital budgeting to decide whether the $11 million Snow Park Lodge expansion would be a good investment. So that's what the capital investment is. We will assume the Hunter Valley's managers develop the following estimates concerning the expansion. So we'll get to all those in just a little bit, and they'll continue this in additional exercises that we will see tonight and also Monday. So just under that, let's assume the Hunter Valley uses the straight line depreciation method and expects the lodge expansion to have a residual value of $800,000 or $600,000, pardon me, at the end of its 7-year life. So 7 years, it's going to be around here with us. So what this is, it's setting us up for the accounting rate of return method. We'll first compute the average annual net cash inflow from the expansion. And then second, compute the average annual operating income from the expansion. So there's the text of the problem. And if I flip down a few pages, we'll see the solution to it.
Professor Quilliam, can you, we can't see your screen.
Oh, you can. I'm sorry about that. Okay. Yeah. Let me fix that here right now. Glad you noticed. Let's see, it's supposed to be sharing and it's not. Let me just go ahead and click here on another button there, not the one that automatically shares my screen with whatever's popped up, but it's just going to share for the moment what's in the book. Can you see it now?
Yeah, we can see it.
Okay.
Thank you.
It just wasn't working quite right there. All right, so here it is here in short exercise 26.4. So we're using this Hunter Valley Snow Park Lodge, $11 million expansion. Have some information here about it. And we see it's going to have a life of 7 years, residual value of $600,000. And I will get to those and the other numbers here in just a bit as we need them. So requirements will compute the average annual net cash inflow and then the average annual operating income from the expansion. These things will set us up for the accounting rate of return method. All right, so what they do here is based on the information, they first compute average annual cash inflow. So we will look at the average cash spent by each skier per day, which is given to us in that table, is $241. Multiply that by the additional skiers per day that we would get if we expand. We predict that we would get 121 extra skiers per day. Then can't ski every day of the year, so just look at the average days of skiing per year, 142. Multiply all those out, and we'll get average annual cash inflow of $4,140,862. Then they look at average annual cash outflow. So the average variable cost of serving each skier per day of 83, multiply again by the additional skiers per day that this expansion would give us, 121, and multiply by the average days of skiing per year, 142. So that will give us an average annual cash outflow of $1,426,106. So now we get the average annual net cash inflow. So net means let's take those inflows and subtract the outflows. So the inflows, again, $4,140,862 minus the outflow, $1,426,106, which will give us a net amount of $2,714,756. that make sense? Okay. They just gave us kind of a long-winded way of having compute that. Now, number 2. First thing they look at, total net cash inflows during the operating life of the expansion. Well, if we look at the average annual net cash inflow multiplied by 7 years, so we get $19,003,292. Then here's that depreciation, the non-cash expense. So total depreciation over the operating life of the expansion, it would be the cost of $11 million, the initial cost, minus the salvage or residual value of $600,000, which gives us $10,400,000. So they took the total net cash inflows during the operating life of the expansion, and then they subtracted depreciation from that. That brings them down to accrual accounting income. So total operating income during the operating life. So there's the accrual accounting or GAAP-based income figure, $8,603,292. Then they want a per year amount. So they divide by the operating life in years, 7 years, to get the average annual operating income from the expansion. So $1,229,042. So you could get that amount by taking the totals and dividing by 7, or you could do a per year figure here, 2.7 million, and subtract off depreciation per year from it if you wanted. So more than one way you get the answer. So any questions there on the exercise? And I've got this PDF for you online. It's on Canvas there for you. And if you have any trouble finding it, just let me know. Sometimes Canvas can be a little bit confusing. So nothing else there. All righty. Let's come to the next problem. Just going to go up here to it. And it's number 5. So we're going to use the payback period method. We're going to refer to the same problem, compute the payback for the expansion project, rounding to 1 decimal place. So just a little bit of review of payback. Let me come down here to the answer. And here we have it. For payback, just a reminder that we take the amount invested and divide by the expected annual net cash inflow. They have an even expected annual net cash inflow, so all the amounts are equal, so we can simply divide like this. So in order to do this, they take the initial cost of $11 million, and then they divide by the expected net cash inflow per year, which is $2,714,756 to get 4.1 years, rounded to the nearest 1/10 of a year. By the way, to remind us as to where that 2.7 million came from, we did calculate that here in the previous example. It's from right there. All right, any questions there about that one? Okay. And let me come back up here a few pages to look at what's required for number 6. So number 6, using the accounting rate of return method to make capital investment decisions. So we'll refer to the same expansion, calculate the accounting rate of return. We'll round to 2 decimal places. So let me come back down here to the solution. So there, number 6. one figure that we're going to need, which is for the denominator of accounting rate of return, is going to be the average amount invested. So that equals the initial investment of 11 million plus the residual or salvage value of 600,000. Then we divide by 2 to get an average, a mean. That will equal 5.8 million. So now for accounting rate of return, we have everything we need. We can plug and play. So we take the average annual operating income, which we've calculated right over here in the first problem, $1,229,042. And we divide by the average amount invested, 5.8 million. That gives us an accounting rate of return of 21.19%. So that's a really good rate of return if you can get it. And that takes care of number 6. Any questions here on it? Got everything you need? Okay, I'll go ahead back here to my notes. So I skipped over 3 back here. I've got, first of all, the companies which use accounting rate of return will set a minimum accounting rate of return for capital investments. And they'll reject capital investments with accounting rates of return less than this percentage, less than what they wish to earn. So with accounting rate of return, again, higher is better. Any rate of return is.
We can only see the example still.
Whoops. Okay, let me come back here to my screen share. All right. Okay, and let me go ahead and reconfigure this since it's not exactly working too well here tonight. Let me see if this is going to work. Can you see it now? Oh, yeah, good.
Thank you.
Thanks. So then G. An advantage of accounting rate of return is that it considers accrual accounting income figures over the entire operating life of the asset, unlike the payback period method. With the payback period method, we're only concerned until we get paid back, then we ignore any other cash flows after that time. With the accounting rate of return method, we consider all 7 years of this project's life. Well, therefore, it shows how the investment will affect accrual accounting operating income. That's important to financial statement users. So that's a major advantage of it. Now in H, a disadvantage of accounting rate of return is it ignores the time value of money. Therefore, like the payback period method, it's an initial screen for investments. Then if something looks better, well, we'll subject it to one of the 2 methods that we're going to see on Monday, and those are more sophisticated. So on Monday, we'll start off with time value of money, and then we'll go through those other 2 methods. So those other 2 methods are also in problems in that PDF file that we were just looking at. So that's what I've got for you tonight. What questions do you have? Anything? Nope. Okay. Well, very good. So then Monday evening, we'll be talking from my hometown in Indiana, where I know it's going to be a whole lot colder. And I'll make sure that I take my little Dollar Tree whiteboard with me to Indiana. If not, I'll stop at Dollar Tree up there and just hope they still have them in stock from all the poor teachers who had to go get them since the county was just declared a red zone and they will not be having live class. Somehow I wonder if they conveniently declared that just in time for Thanksgiving because they're limiting how many people can gather. Yeah, up to 25 people. So maybe I'm just being a little bit too skeptical there. I don't know. So have a wonderful Thanksgiving. As you know, Wednesday, when we normally meet, is a holiday. So that's part of Thanksgiving recess. So we'll meet next on Monday and we'll finish out chapter 26. And that'll be the last bit of new material for the course. All righty. Well, thank you. And again, let me know if you have any questions.
Thank you. Have a good Thanksgiving too.
Thanks. You too. Thanks. Bye-bye.